number one opportunity for me personally, where I'm going to be placing my own personal capital, the greatest allocation is oil and gas. I've never seen anything like this. And it's really time to get over your fears and dip your toe and make some money here. I think the distressed debt is a real opportunity. I think there's going to be real opportunities coming in down the pike with stuff that's hitting the fan. And I've always loved distressed debt.
Hello, left fielders. Welcome to the Passive Investing from Left Field podcast. Our community is focused on networking and education to help people invest passively and think differently. Let's go. This is the second part of the two-part podcast interview with Bob Fraser. If you didn't catch part one last week, please be sure to listen to that first so you don't miss out on any of the great content from Bob. On to part two. So I'd like to pivot now into the mega trends, right? Because this is something that I've heard you talk numerous times about it, and so I think in the presentation I most recently saw, you had four of them: demographics, energy, inflation, and interest rates. So can we start with demographics? You touched on it a little bit, but just tell us what the trend is and what you're seeing, and then at each trend, like how can we capitalize? What are the asset classes that will help us capitalize on that trend?
All right. Well, demographics is a shocker. I mean, when I give these stats, people look at me like I've got three heads, and this is mathematics, guys. This is the United Nations population databases, okay? This is stuff that is well researched. And here's the truth, that China, within 75 years, China's population will be just about half what it is today. Their population of half. Imagine a China with 50% fewer people. I mean, how many roads do they need? How many apartment complexes are they going to be needing? How many, and it's worse than this. They're going to lose half of their population, but 2/3 of their workforce are going to be gone. Well, how does a nation that's a manufacturing power lose 2/3 of its workforce, right? If you don't think this changes the world and everything in the world, you're not watching. So demographics are like the demographics of economics, right? Or the glaciers of economics. They move imperceptibly slow, but they also change the entire landscape incredibly. And it is a very big deal. China is not going to be an industrial power anymore. By the time your grandchildren are your age, or your grandchildren are your age, they're not going to be an industrial power. They're going to be a second-rate power trying to, and we'll see if the communist regime can even survive this, right? So that's critical. And you look, it's not too far off in all of Asia. It's not too dissimilar in Russia and some of the other countries. A lot of the bad boy nations, they have massive demographic problems. Italy is kind of unbelievable. We've never seen demographics like this. We're literally, it's going to be like a retirement home. I mean, there's nobody left. And in Italy, who's gonna make the espresso? I mean, everyone is just retired in the entire nation. We've never seen anything like it. We don't even have economic models for this. So that's where I'll put on my head and I'll noodle for a while and think, okay, I'll make speculations about what I think might happen. But it's going to change everything. And China's problem is all self-created. They had a one-child policy, 350 million forced abortions. That is the entire population of the United States aborted, and they favored aborting females. Right. And so and by the way, females, as last I heard, are the ones who make babies, right? So they carry babies, and in fact, they call it a birth ratio, and you have to have 2.1 births per woman to maintain a population. They're right now at 1.15 births per woman, and they don't even have enough women. So the problem is their population of young women is teeny tiny. And the ones that they do have are only having 1.15 children. They are so locked in and they are so screwed as a nation. Well, what does that mean? Well, this plays into a larger trend of deglobalization. So the world is massively globalized since 1945, the end of World War II. And when the US kind of set up this Pax Americana, right, and enforced global trade and policed the nation's oceans and limited bad boy operators across. I mean, prior to World War II, trade wasn't global because there was too many bad boy operators that would interdict shipping lanes and piracy and whatever. That all stopped. Well, and if you look at, you can measure the trade, the percentage of trade divided by GDP, and it just went up and to the right until just a few years ago, and it reversed. You're seeing a massive deglobalization trend. What happened is the world realized it has over-globalized. That a lot of times it doesn't make sense to globalize that much. And right now, it's cheaper to manufacture in America than in China for a lot of things. If you count robotics, you count shipping, you count tariffs, and certainly if you count supply chain risk, right? Add to the fact that you know who the world's largest oil producer is. Well, it's actually America. It's the United States.
Yeah.
And well, if you need energy security, or you have an energy intensive business, there's only one nation in the world you want to be in. Do you know China imports all of its oil from Saudi Arabia? Well, okay, what happens if they lose access to that? In America, that's not a problem. And furthermore, right now, natural gas prices, $2.50 a thousand cubic feet in America. In Europe, it's $15. And in Asia, it's $15. You have an energy intensive industry at all. There's only one place in the world you want to be right now, and that's America. We're the only industrialized nation and industrial power that has access to energy. The only one. So anyhow, this is all driving an industrial boom in America, reindustrialization of America, and it's just beginning. We've got at least 2 decades in this. So it's a massive megatrend. The world's deglobalizing. By the way, America's population, we do not have the demographic tsunami of other nations. We actually have a millennial population. I mean, I say we don't understand them, but we're glad they're here, and America has a demographic future. When a lot of nations really don't, they're going to become shells of themselves. And the world population is declining right now. And shocker of all shockers, we've seen. So anyhow, it changes everything. And one of the biggest trends we're tracking right now is industrial real estate in America, which we think, right now, vacancy rates of Class A industrial space is basically nil. And in spite of, I can't remember how many hundreds of millions of square feet was brought online and it fully absorbed. Last stat I saw from Prologis, who's a large REIT, industrial REIT, said just their existing clients need 800 million square feet of space. 800 million square feet of space needed.
Wow.
And in spite of all the building, it's not enough. And like I said, the numbers are there. We're building at 65 a square foot in industrial part of Wichita, and it's worth $1.20 square foot once we're done, and leased. And if we lease to a credit tenant, it's even more than that. So,
yeah, that's great. So the next trend is energy. And I know some of these, kind of overlap a little bit, but can you talk about what's happening in energy and what's going to happen in energy?
Yeah. Energy is something real estate investors need to get comfortable with. Okay. So most people, everyone knows someone who lost money in energy, right? It's definite. One of my partners said, definition of an oil well is a hole in the ground with a liar on top, and I get that, but trust me, there's a lot of money being made in oil, right? Some of the largest companies in the world. So there's money there. You just got to make sure you get the right people and not the wrong people, because it's minting money. Well, what's happened, this is the biggest ridiculous thing in the world. So what happened, remember the Obama recession that never quite ended, right? From 2010, and the economy never quite recovered. Bless his heart, he couldn't get behind business and help, business create jobs. Couldn't do it, But we had this thing where demand for energy just was kind of plateauing. And the narrative came out that we were now post-fossil fuels. The world was post-fossil fuels. We don't need them anymore. And what happened? Well, then who would want to invest in a dying business? And besides it's dying, it's dirty, right? It's dirty. It's ugly. If you say I'm a fossil fuel investor, I'm pumping oil. You got to put a paper bag over your head. All right. But that's the time when you got to put a paper bag over your head. That's the time you want to be investing. Okay. When everything's hated. Well, so what happened? The world stopped investing in energy. And in 2015, since 2015, we've seen a 55% decline in investment in new energy production. This is horrible. The world's not developing oil fields and hasn't for the last 7 years. And right now, we're seeing a 5 to 7% decline in oil capacity, oil production every year because of depletion, right? That's just the nature of the game. We need 5 million barrels a day of new production every year just to make up for that. And that takes investment, takes a massive amount of drilling, developing, and the world hasn't been doing it. So we're seeing a massive supply constraint. It's just supply constraint is just coming down like crazy. As soon as demand hits this, increase in demand is going to be met by inelastic supply. Do you know what inelastic supply means? It means it doesn't matter what the price is, you're not going to get more oil. There's no more oil to get. There's nothing to turn on anymore. And so this is just insane what the world has done and extremely foolish. I mean, John Kerry has been running around defunding fossil fuel investment for the last 10 years and trying to get big money to pull money out of oil and not loan to oil companies. Well, oil companies, they've quit borrowing money. They're so sick of it. They're done. I said, no, I'm not going to, Biden is telling me, hey, drill. They're like, yeah, right. And then what? And then, the current administration is going to Venezuela to ask them to increase oil. These are the American hating, Marxist, it's kind of ridiculous, but, foolishness ends up always being exposed, and it's about to be exposed. So we're seeing a huge opportunity here, opportunity of a lifetime. Really, it's an opportunity of a generation to get into oil and gas when it's incredibly cheap. Here's the other thing. You know what a cap rate is, right? Unlevered income, unlevered yield on capital, right? And if you could get an apartment complex right now, Class A, you're maybe going to be getting it at a 4 or 5 cap rate. Do you know what the cap rate is of oil fields right now? 15.
Really?
15. Yeah. So, and that includes fields that are 20% developed and have all this 5x upside of new drilling opportunities. Yeah.
That's the opportunity?
The definition of being on sale, Jim. That is on freaking sale. And if we're not buying, so I'm just hoping oil prices stay low for the remainder of the year while we're rounding out our portfolio and we're just backing up the truck now and buying great assets at fire sale prices, and pretty pumped about it.
What are the opportunities there? Like, is it the drilling? Is it the owning of the mineral rights? How do investors capitalize on this energy issue?
Really anything. Our favorite is you can make money on property rights, the royalty interests. The problem is a lot of people park a lot of money and it ends up just sitting there and not really producing much, right? You got to be super smart about understanding where the development is going. All right. So we don't like that as much. I'm the kind of guy that I really want to be able to pull some levers and push some buttons to make money, right? Not the guy who I want to park somewhere and hope money comes to me or hope somebody throws money. I'm not that guy. So our favorite is the non-operated working interests. So where we own the leases, we buy the leases from the royalty owners, right? The landowners, and we agree to pay them royalties, and we own the lease, and then we don't operate that lease. We give another operator access to that lease, and we share the revenues. And so what we're buying right now is non-operating working interest, where the operators are oil companies, named oil companies that you would know. These are the big guys who bring kind of massive amounts of expertise and resources to bear. And we don't have to, turn a drill or something. So that's our favorite. We like this favorite strategy that fits our profile. And like I said, 15% returns. The money is in the drilling. I mean, we just drilled 3 wells in one of our existing things, and all 3 hit, and they just start throwing off money like you would not believe. These things hit. And people think of it, you think about the good old days when, you get a dry well, or, it's really not like that anymore. The geology is so well understood that dry wells are very, very rare, right? And especially if you're doing horizontal, they know where the layers are, and they just go till they hit the layer, then they turn and go horizontal, and they just start plowing through the layer, and it's just, this is very well understood. And the technology is very advanced. They have lots of, seismic technologies and other technology where they can model what's below the ground with great accuracy. So it's just not that risky. So it's just an incredible opportunity that most people are afraid of. And I'm glad that they are, because that makes them cheap as dirt.
Well, how do the LPs get over that? Right? There's in our community, we bring up oil and gas, and you'll get 5, 10, 20 people. Oh man, I lost money on that. Ponzi scheme, not Ponzi scheme, dry wells, whatever. How do people get comfortable with an asset class like this? Because it is known to be boom and bust. A lot of people have lost money on it. A lot of people have made money on it. And when we're investing real estate, we're typically thinking, our capital, if we pick the right operator, our capital should be safe and we're going to earn a return on that. But with oil and gas, the reputation is, even with a good operator, you might lose. So how do you get comfortable with that as an LP?
Don't do anything you're not comfortable with. And if you're not comfortable with it, well, stay out of it. At the end of the day, you want to go to bed at night and not worry about anything, right? And have a good night's sleep. But that said, hey, dip your toe, man. Take 10% of your portfolio and try it out with a good operator and see what happens. But and these things, these oil fields have a lot of residual value too. It is real estate at the end of the day. It's treated like real estate. And the last deal we did, we bought 23,000 acres, leases on 23,000 acres, and the returns are wonderful, but it's only 20% developed. So we're basically putting in a drilling program right now, and it's just, the returns are insane. And we can do this for 10 years and sell it for more money than we got into it. So, it is real estate at the end of the day. And really, the real issue is operators. That's the real issue. There's a lot of shady operators out there. Don't go with the little guy, who knows what he's selling, right? The brother-in-law deal. Go with seasoned operators.
That makes sense. So the next one, megatrends, is persistent inflation. And you mentioned this briefly, that you think inflation is going to be around for a long time. So can you talk about inflation?
Yes. There's a few things happening. One is demographics. So a lot of inflation, or a lot of the low inflation or low interest rates environment was brought about by the baby boomers hitting their key wealth earning years and putting their money into the markets. And as more money flooded the markets, it necessarily drove down returns. We're seeing aging baby boomers now, and they're going to be pulling money out of the market. So we're seeing necessarily higher interest rates as there's just fewer deposits and investments, happening. That's a kind of a smaller, longer term thing. Another thing we see is energy. So if you actually break down the CPI rises we had last year, the big increases, almost all of it was due to rising energy prices. And if you look at the easing of inflation recently, it's almost entirely due to energy prices. that energy is a significant component of inflation. And what's more is energy is kind of what I call the mother of all commodities, right? You think of, well, wheat is different than oil, right? But guess what? If you're going to plant and harvest and weed and all this stuff, you're going to use diesel tractors. It's all energy. Everything takes energy. Everything takes energy. It's the mother of all commodities. And so if diesel prices or energy prices rise, everything rises.
Right.
And so my view is that if energy prices remain elevated, you're going to see more persistent inflation. And I believe we will see higher energy prices for the reasons I just gave. And megatrend number 2 there, So that's number 3 kind of driver inflation, and number 2 driver inflation. Number 3 driver of inflation is the kind of the changes in the workforce. So we're seeing a lot of people retiring. We're seeing aging of the workforce. Again, it is demographics. We're seeing people aging out of the workforce. So there was a really interesting chart. If you saw the labor participation rate, which is the percentage of the population that is considered in the job market during COVID, it's spiked down, and it never quite recovered. And everybody's arguing about why hasn't people gone back to work? And then BlackRock came out with a chart that showed they overlaid demographic changes, and it turns out it was aged out. People took COVID and took a retirement and said, let me begin my retirement. This is not changing. We're seeing there's just fewer and fewer young people, and so we're going to see wages be more elevated. And you're seeing, McDonald's now, you're ordering from a machine, a lot of times. Yeah. Everything's changing about this, and so wages are going to be elevated because there's just worker shortages for demographic reasons. So those are the things that are going to keep inflation higher than most analysts are predicting. I'm one of the few out there that's basically saying this, and I've been saying this for a couple of years now, and so far I've been right, and I think I'm going to be. So we'll see.
So do you think the inflation issue was coming regardless because of demographics, or was it accelerated by the pandemic, the war in Europe, the supply chain, all of that stuff? Is it all combined in there? And are we going to get the supply chain back from post-COVID, or is that going to help a little bit, I guess is the question?
Yes. You see, COVID created a crisis, but it also, we have long-term trends of demographics that are underlying, but the crisis did happen. Same with supply chain and the disruption of oil out of Russia, drove up prices, but it's beyond that. It's only exposing these big trends, these glacial trends under the surface that we caught the first edge of that, the first stress points on there. And so we're going to see it's both. We're seeing it would not be evident, right? It's this lack of supply meets any kind of demand change. You as soon as there's a little crisis, you're going to see it exposed with high prices, right? And then the next crisis again, and then the next crisis is going to be sooner and again, and that's what happened.
Right. All right. So the fourth trend was interest rates. You want to talk about interest rates?
And what was the trend about interest rates?
I think that was just one of the ones on your list of 4 mega trends was the interest rates. I assume it was the interest rate increasing, or is that not one of your trends? That's what I had on my list.
Yeah, I think. Well, I think the trend was really what we talked about at the beginning of the show, which was kind of the defaults coming, and
okay.
So we're going to be seeing these. We've already talked about this. So we're seeing defaults hitting the market as interest rates become all deals that penciled at 3% interest rates don't pencil anymore, and there's a lot of deals that shouldn't be done, and you're going to see some real blowups from those things.
Okay, so we've talked about 4 basically trends, right? Mega trends you talk about. So the opportunities then sounds like so far we've heard industrial and oil and gas. and probably distressed real estate. Now, what are some other asset classes that we should be looking at to capitalize on some of these trends that we're in the middle of or going into?
Yeah, some of the opportunities. Well, number one opportunity for me personally, where I'm going to be placing my own personal capital to the greatest allocation, is oil and gas. I've never seen anything like this, and it's really time to get over your fears and dip your toe and make some money here. I think the distressed debt is a real opportunity. I think there's going to be real opportunities coming in down the pike with stuff that's hitting the fan. And I've always loved distressed debt, and we're looking at putting together a distressed debt fund. I mean, we love distressed debt. We've got a lot of track record in that, and so we're kind of thinking about this, but it's a little early right now. I think it might be more. I think it might be, might wait 18 months or 2 years, and then we'll put a distressed debt fund in place.
What can you tell us? What is distressed debt? Like, obviously, it's distressed debt, right? It's debt that has problems, but how do you solve that problem? How do you invest in that?
Well, what we would do is put a fund together that would go and basically do equity deals where we buy out we would go and say, hey, we'll become senior. You're an operator with a deal that's marginal, and we'll come in above the senior loan. We'll come in with the mezzanine debt, for instance, and we'll charge very high interest rates. But you think you can fix this deal? Great. If you fix this deal, you pay us off, we're going to make our high interest rates. If not, we're going to take over the deal and do a cram down of your equity. And now it's our deal. So those kind of things. There's lots of ways to structure it. There's mezzanine, there's bridge, there's a lot of things. So, but again, I just think it's a little early in the markets right now. You're seeing a wide bid-ask spread. So you're seeing a lot of what people are willing to pay for a property, and no one's willing to sell it for that yet. But we'll be seeing that. So distressed debt is a big opportunity. I think building, I think construction is legit. There's still a lot of demand, and if you look at the big economic forecast I've been doing, we're seeing, and I've said this for well over a year. I said the Fed can put us into recession if they want, but they're going to have a hell of a time doing it. The economy is on freaking fire. And it has been because of the stimulus and a lot of things. And it, we're at the end of the time here, but I got a good dozen reasons what's happening in the market. So there's a huge demand. I mean, retail sales has been on this massive up into the right trend until COVID. And then it's now up 30% above its uptrend. I mean, it's insane. People are going shopping like there's no tomorrow. $4 trillion in excess capital sitting in people's bank accounts from stimulus. And the wealth effect is well enforced from, the rising stock market, rising house prices. And so huge opportunity. There's a huge demand. I don't want to buy stuff, but I can build stuff. So I think I'm just very much into development right now. And I think, we're looking at doing multifamily development. We're looking at doing commercial development. Another area we like, again, that is on sale is retail. Okay. And we love neighborhood retail. Do you know what the cap rates right now on neighborhood retail centers are?
I assume it's high. I assume it's is it a bag on your head asset class?
Not quite. Close. 9.5% cap rates. That means it's cash flowing at 9.5%. Well, these things, nothing has been built. The neighborhood centers have not been built for the last 15 years. And so there's massive shortages, and demand is off the chain because of work from home. Everybody's shopping at their neighborhood, right? They're going to get their nails done and getting the liquor store and their dog groomer. People have a home-centric living right now. And this stuff is just on sale and no one wants it. We're able to pick the stuff up for a song. And you do a little value add, like bringing rents to triple net and bring them to market. And we're just minting money in these things. So we love certain kinds of retail, not all retail, certain kinds. We're very picky about that. Industrial, as I said, we're super, super bullish. The vacancy rate of big industrial boom has been driven in the last 10 years by e-commerce. That's plateauing. But the next 2 decades is going to be driven by by deglobalization and reindustrialization, reshoring. $1 trillion U.S. companies spent last year to reshore. $1 trillion. It's going to happen again this year. So those are some of the biggest things that I'm paying attention to.
That's great. So I know we are running long here today, and that this has been fantastic. If you have a couple more minutes, you mentioned that you do write economic forecasts. Can you talk a little bit about what you see for the second half of 2023 and beyond? I know we've talked about a lot of things that you see coming, but just generally, like, where do you see things going? Especially with, I don't know, by the time this podcast releases, maybe the debt ceiling conversation is over. But can you just talk generally about economic forecast and what you see coming?
Well, the Fed is working real hard to try and cool the economy. But the problem is the economy is just as hot as I've ever seen it. And it's because of the stimulus. So I actually describe why. The stimulus that they did is different than every other stimulus that's ever been done with direct payments to individuals. And we figured out that if you lower interest rates, well, that's great, but only if people want to borrow money, right? What if they don't want to borrow money, right? Back in 2009, you couldn't convince anybody to borrow money to build a factory, right? No one is like, right. Forget it. I don't need to do a factory. No one wants a factory, but if you go take, trillions of dollars and you pump them into people's bank accounts, guess what happened? I mean, let's say we wired the population of America, every man, woman, and child, $1 million, just wired it to them. Boom. What's going to happen? Well, most of them would quit their job, right? Which is exactly what we saw happen. And then to go start buying things. They go shopping like crazy and buying everything. That's exactly what we've seen happening. And so the stimulus they did is, we figured out this has never been done. Well, now we know what happens. It's like this jolt, incredible high. And there's so much liquidity in the economy right now. And it's not going away anytime soon. So the Fed is going to have a hell of a time cooling the economy. Now they can do it. But it's not going to be easy. So far, I have been predicting a soft landing. That's changing a little bit with the banking crisis that happened. And I don't know. I don't think the debt ceiling is a big deal yet. I mean, it's not a big deal until it is. But right now, it's kind of whatever. I don't think they're going to default. But if they did, it is going to be tough. But assuming it's just negotiating and they'll get over that like they always do. The bigger issue is the bank crisis, which, small banks are responsible for a lot of small business lending, and small business lending is the major job creator in America. So that's really drying up a lot of capital at a place where it's needed, and the big banks don't do small business lending really. And so I'm more towards, we might be a little bit harder than a soft landing at this point, but I don't think it's going to be a crash. There's just too much strength in the economy right now. So again, we'll see. But yeah, I'm pretty optimistic.
Good. I'm glad to hear that. So the last question I always ask is, what's a great podcast that you listen to? And you cannot say Invest Like a Billionaire. That's your podcast. That's going to be in the show notes anyway. So we'll put that in there. But what's another podcast that you listen to?
One of my faves that I'm listening to now is Peter Zehan on geopolitics. So I'm really enjoying him.
Okay, awesome. We'll put that in the show notes along with Invest Like a Billionaire. That's a great podcast. It's always one of my favorites. There's lots of great information, so I recommend everybody go check that one out. If listeners want to get in touch with you or learn more about Aspen, what's the best way to do that?
Aspen, like the tree, funds, funds.us. And left fielders, go make some money in 2023.
That's right. That's the goal. That's the goal. And we can talk more about that in October. Hopefully we'll have you at the conference again. But this has been fantastic. Appreciate your time here. I know we went over, but I really appreciate your flexibility and great content as always. So thank you very much for being on the show.
Pleasure to be here with you as always.
So hope you enjoyed part 2 of the conversation with Bob Fraser from Aspen. He just fascinates me with so much good information. And this second part was talking about mega trends mostly, and was talking about where we're going and economic forecasting. And the mega trends were demographics. And I loved how he talked about that as a glacier, right? It's slow, but it's unavoidable. It's coming and it's going to just grind everything in its way. And it's really going to change things. So it's important for us to understand demographics and what's coming. Energy. He says, I love it. If you've got to put a paper bag over your head to invest in, it's probably a good time to invest. So yeah, there are some problems with energy and issues that people have had in the past with losing money. And it's also, most of the energy investments are not clean and people are moving towards a cleaner type energy, but we're not there yet. It has to be all of the above. We can't just go wind, solar, and forget oil. Unfortunately, we're going to have to be with oil for a while. So if we can make some money off of it, that seems to make sense to me. And it's a paper bag asset class. So maybe now it's time for it. Another one he said was paper bag asset class was retail. So maybe that's something to look at as well. And he talked about inflation and some of the causes there and how he thinks it's going to be for a while that we're going to be involved in this inflation. And there's lots of reasons, and it probably would have happened without the pandemic, but the pandemic just kind of accelerated everything. And then all the money that was handed out really caused issues that are longer term than I think people thought. So there's a lot going on right now. There's a lot of uncertainties in the economy, but I was pleased that Bob thinks that, a soft landing is possible, but regardless, he has a positive outlook on the economy and bullish about America. And part of that was in the first conversation we had talking about China and demographics, and the demographics really are going to make a difference in everything. And the U.S. is in a good place because we might be not getting to the 2.1 children per woman to kind of keep the growth, but we're not falling like the other countries. And so, I think our situation is going to be better than most because also we have energy independence, which is crucial. He talked about, again, countries like China and some of the European countries do not have that, and their costs are going to be much higher than us. So the U.S. is in a good place, and he has confidence, and that makes me feel good. And again, I just love talking to Bob. We'll get him on. I think last time it was almost 2 years between episodes with Bob, but we'll make sure to do another checkup with him in 6 months or a year just to see how things are going. So that was great talking to Bob. He's always interesting, and we hope to see him in October in the meetup in left field. He put it on his calendar, so he'll hopefully be one of the speakers there. And until then, that's all we have. We'll see you next time in the left field.